So, thanks to the war in Iran, it looks like the United States economy and the investment markets are on the verge of a major deleveraging cycle. If you have a 401k, and let's be honest, most working Americans do, this could be one of the most important things you pay attention to right now. There's something happening in the background, something that very few everyday investors fully understand, yet it directly touches the retirement money of millions of people. It's called the private credit market. Let me break it down for you in the simplest possible terms, because this stuff gets complicated fast, but it doesn't have to be confusing. Private credit, at its core, is exactly what it sounds like: private loans made to privately owned companies, privately owned real estate projects, and privately owned infrastructure. Think of it this way: when you or I need a loan, we usually walk into a bank, fill out paperwork, and hope for the best. Banks are heavily regulated. There are strict rules about how much risk they can take, how much capital they have to hold back, and how transparent they must be with regulators and customers. But over the last 20 years, especially since the 2008 financial crisis, something else has quietly grown in the shadows. Economists call it shadow banking, but the more common and accurate term today is the private credit market. Big players like Blackstone, Apollo Global Management, Blue Owl Capital, KKR, Ares Management, and Carlyle Group stepped into the gap that traditional banks left behind. After Dodd-Frank and all the new rules that made banks pull back from riskier lending, these alternative asset managers said, "We'll take that business." And they did, in a massive way. Hold on. Where did they get all that money from? That's the part that should make every 401k holder sit up straight. They got it from pension funds, from insurance companies, and yes, from everyday retirement investors like you and me whose 401k or IRA plans include alternative investment funds, private credit sleeves, or funds of funds that allocate to these managers. These institutions and retail vehicles funneled trillions into private credit because, during the era of ultra-low interest rates and cheap money, the returns looked fantastic. Double-digit yields with seemingly low volatility? Sign me up, right? Well, sticking with the financials, we're now seeing some very real stress in the names most exposed to private credit. BlackRock and Ares have seen some of the biggest drops among the major players. BlackRock, for example, recently had to limit redemptions in one of its private credit funds after a surge in investor outflows. That's code for, too many people wanted their money back at the same time, and the fund couldn't liquidate positions fast enough without taking big losses. So how concerned should regular investors actually be about the private credit market? Let's put some numbers on this so it feels real. This market has exploded from basically nothing, less than $200 billion 2 decades ago, to roughly $3 trillion in assets under management in just the last 10 years. That's an astonishing growth rate. A lot of that money poured in during the zero-interest rate policy era when investors were desperate for yield anywhere they could find it. Pension systems, university endowments, and even target-date retirement funds that sit inside millions of 401k plans got heavy exposure. The problem is structural. These aren't like bank accounts or even regular mutual funds where you can hit, sell, and get your cash in a day or two. These are long-term, illiquid contracts. The loans are locked up for years, sometimes 5, 7, or even 10 years, because they're financing things like buyout deals, real estate developments, or infrastructure projects that don't generate quick cash flows. When investors get nervous and start demanding their money back, the funds can't just flip a switch and sell everything at fair value. They hit what's called a gate, or redemption limit. Sometimes they suspend withdrawals entirely. Take Blackstone, the world's largest alternative asset manager. They just reported a record level of withdrawal requests from their massive $82 billion credit fund. The requests were so overwhelming that Blackstone had to step in with its own balance sheet and even tap personal capital from employees to bridge the gap and avoid forced fire sales. That's not a small signal. Blue Owl Capital went even further. They completely halted redemptions on one of their flagship retail-oriented private credit funds. BlackRock started imposing limits as well. In plain English, investors are saying, "I want my money," and the industry is replying, Sorry, not all at once, and maybe not right now. And here's what that stress looks like on Wall Street. The stock prices of these very same giants, Blue Owl, KKR, Blackstone, Ares, Apollo, Carlyle, have taken a serious beating in recent weeks. These aren't obscure penny stocks. These are some of the biggest, most sophisticated financial institutions on the planet. When their shares collapse, it's not just rich hedge fund managers feeling the pain. It's a market vote of no confidence in the entire private credit ecosystem. JP Morgan CEO Jamie Dimon issued a blunt warning on his most recent earnings call. He said, quote, "I probably shouldn't say this, but when you see one cockroach, there are probably more." That's not the kind of thing the head of America's largest bank says lightly. He's essentially telling the market, the problems we're seeing in private credit right now are likely just the first visible signs of deeper stress hiding in the system. But private credit isn't the only crack showing up. Look at the price of oil. Thanks to the war in Iran, it has been exploding higher. And this isn't just about gasoline at the pump. It's disrupting global supply chains across the board: natural gas, fertilizers, metals, petrochemicals, plastics, you name it. Every single thing that modern economies run on gets more expensive when energy spikes. Throughout history, major oil price shocks have almost always preceded recessions. 1973, 1979, 1990, 2008, the pattern is clear. When energy costs surge, consumer spending gets crushed, corporate profit margins shrink, and the dominoes start to fall. Then there's the $38 trillion elephant in the room, the federal government's spending problem. We're running trillion-dollar-plus deficits every single year with no end in sight. If current trends continue, and nothing in Washington suggests they will change, the national debt is projected to balloon toward $58 trillion within the next decade. That's not sustainable. Interest payments alone are already crowding out other spending, and eventually something has to give: higher taxes, higher inflation, or both. The jobs market is also flashing warning lights. The U.S. lost 92,000 jobs in February. Economists had been expecting a gain of around 60,000. That's a swing of more than 150,000 jobs in the wrong direction. The unemployment rate ticked up slightly to 4.4%. And that's not all. There have been massive downward revisions to previous months' numbers. In other words, the labor market was never as strong as the headlines made it seem. When you strip away the seasonal adjustments and the birth-death model guesses, the picture looks a lot softer. So maybe everything is fine. Markets might bounce today, they might sell off tomorrow. Nobody has a crystal ball. But the U.S. economy is showing cracks in multiple places at once, and today I want to walk you through them in detail and explain what it could mean for your investments. Later I'll share a really interesting theory about what the U.S. government might ultimately do to try to fix all of this. But first, let's build the foundation. Hi, my name is Orbit. Welcome back to the channel. You come for the finance, you stay for the economy. Just to be crystal clear from the jump, this video is not me screaming that a recession or market crash is imminent tomorrow. I'm not here to scare you into selling everything. Instead, I want to lay out some really important pieces of evidence that suggest the system is moving in a dangerous direction, a direction that has historically led to recessions and painful market corrections. I want you to understand the risks so you can make informed decisions about your own money. Let's start with the single most important concept that ties everything together: leverage. The entire debt-based economy we live in runs on borrowed money. Leverage simply means using debt to amplify returns, or, in bad times, to amplify losses. Households borrow to buy houses and cars. Companies borrow to expand and buy back stock. Governments borrow to fund programs and deficits. When times are good, leverage feels like free money. When times turn, it becomes a trap. The reason the system is so sensitive right now is because leverage creates tight interconnections. It only takes one domino, one seemingly small problem, to start a chain reaction. The best recent example is still 2008. I lived through it, and I remember the fear. It felt like the entire country was defaulting on mortgages and the whole financial system was collapsing. But when you actually look at the numbers, it was shockingly small in scale. Less than 5% of all mortgage loans in the United States actually went bad. Subprime loans themselves were only about 13% of the total mortgage market, and only about a quarter of those went into default. Do the math. Roughly 1.5 to 3% of the entire U.S. mortgage universe triggered the global financial meltdown. How is that possible? Because of leverage and interconnectedness. Those bad loans were packaged into complex securities, leveraged up in banks and hedge funds, insured through credit default swaps, and held by institutions all over the world. When the first cracks appeared, the dominoes fell fast. Banks stopped lending to each other, liquidity evaporated, and asset prices spiraled downward. I'm not saying today is exactly 2008. The trigger is different. The worry right now isn't subprime mortgages, it's what exploding oil prices could do to corporate balance sheets and consumer wallets, and what rapid advances in AI and technology could do to the job market. I want to be very clear here, we are not at the point where robots are about to take every single job. But it doesn't have to be every job. It only has to be enough jobs to push the unemployment rate into the danger zone. Macro analyst Luke Groman has pointed out that historically, once unemployment climbs into the 6 to 8% range, a self-reinforcing negative feedback loop often takes hold. Laid-off workers cut spending, businesses see lower revenue, they lay off more workers, and the cycle deepens. We're not there yet. Unemployment is still relatively low at 4.4%. But the trend is moving in the wrong direction, and the private credit stress we're seeing could accelerate that move if companies that rely on those loans start to feel the pinch. Now, let's circle back to your 401k for a moment, because this is where it gets personal. Many retirement plans now offer alternative investment options, private equity, private real estate, and yes, private credit. On paper, these assets look great because they're less correlated with public stocks and bonds. In reality, they are highly illiquid and can become impossible to exit exactly when you need the money most. When private credit funds start gating redemptions, the pain doesn't stay confined to the ultra-wealthy. It flows back to the pension funds and 401k plans that allocated capital there. Those plans then have to adjust their overall portfolios, sometimes by selling liquid assets at exactly the wrong time. Deleveraging is the process of reducing overall debt levels across the economy, either voluntarily or, more often, involuntarily through defaults, bankruptcies, and forced asset sales. When it happens on a large scale, it's painful. Asset prices fall, credit tightens, spending slows, and growth stalls. The private credit market, for all its sophistication, is now sitting right in the middle of that potential storm. The stocks of the big alternative managers are already pricing in some of that risk. When Blackstone, KKR, Apollo, Ares, Carlyle, and Blue Owl all drop together, the market is telling us that the era of easy money in private lending may be ending. Higher interest rates for longer have already made new deals less attractive, while existing borrowers are facing refinancing walls at much higher rates. Add in geopolitical shocks from the Middle East, and you have a recipe for higher defaults down the road. Meanwhile, the government's massive borrowing continues to suck oxygen out of the private sector. Every dollar the Treasury borrows is a dollar that isn't available for private investment, or it pushes interest rates higher than they otherwise would be. At some point, the math becomes unsustainable, and markets start to demand higher yields on U.S. debt, which makes the deficit even worse. It's a vicious circle. And then there's the human side, the jobs. Losing 92,000 jobs in a single month when economists expected gains is not just a statistical blip. It's a signal that businesses are getting cautious. They're slowing hiring, maybe even starting to cut back. When you combine that with higher energy costs eating into consumer budgets, the risk of a slowdown turns into a very real probability. So where does this all lead? I've been studying these cycles for years, and there is a really interesting theory circulating in certain macro circles about what the US government might ultimately do if the deleveraging pressure becomes too great. The idea is that, rather than allow a full-blown 2008-style collapse or a Japan-style lost decade, policymakers could turn to more aggressive forms of debt monetization or direct intervention, things like coordinated fiscal and monetary easing on a scale we haven't seen outside of wartime. But that's a discussion for the next video, because it deserves its own deep dive. For now, the key takeaway is this: the system is leveraged, interconnected, and showing multiple points of stress at the same time. Private credit illiquidity is the latest visible crack. Oil prices and supply chain shocks are adding fuel. The jobs market is softening faster than expected. And the government's debt trajectory is a slow-moving freight train coming down the tracks. None of this means you should panic and pull 100% of your equity out tomorrow. Markets can stay irrational longer than any of us can stay solvent. But it does mean you should understand where your retirement money is really sitting, how liquid it actually is, and what risks are hiding inside those alternative sleeves of your 401k. If you found this breakdown helpful, hit that like button, subscribe, and drop a comment below. How much of your retirement is in private credit or alternative funds? Have you ever tried to understand the fine print on those allocations? Let's keep the conversation going. I'll see you in the next one, where we'll dig even deeper into what the government's potential fix might look like and what it could mean for your savings. Until then, stay informed, stay calm, and protect what you've worked so hard to build.